In this week's video, we'll review the latest charts and data to help us answer the question, healthy rotation or a major topping pattern? Video is being recorded on Friday, February 6th, 2026, intraday around 2:40 p.m. Eastern Time during a strong and broad rally. A handful of charts that follow come from the January 15th, 2026 video. This is the tech sector XLK relative to foreign stocks ACWX. You can see some weakness in the trend up here, some vulnerability here that we talked about in mid-January. In that same January 15th video, we covered observable improvement in XME, metals and mining stocks, relative to the S&P 500, relative to the 200-week moving average shown in red, and this consolidation box that dates back to calendar year 2015. And back on January 15th, we reminded everyone that technical analysis is about subtle shifts in human behavior. It was also relevant that leadership was starting to emerge in an area other than large cap growth. This is a large cap value ETF with a relatively small weighting to tech, 9.19%. This is FNDF relative to SPY. And in the January 16th video, where we covered charts dated January 16th and January 15th, we talked about the potential vulnerability here on MGK, mega cap growth, with a heavy Magnificent 7 exposure, relative to RSP with only about a 2% exposure to the Magnificent 7. This was the look of the chart on January 16th. If we fast forward to the present day, February 6th, we can see this area here that could potentially have acted as support thus far is not acting as support. And if we zoomed in down here, the strength of the trend, MGK relative to RSP, appears to be weaker today than anything that we've seen dating back to 2023. This is incremental and observable deterioration in the relative trend. And then in last week's video, we asked and answered, does it still look like a bull market? The answer a week ago was yes. The answer intra-week, when we updated our models, was still yes. And ultimately, in this week's video, we're going to dig a little bit deeper into these questions that we've been discussing for over a month now. January 30th, emerging markets relative to the S&P 500. January 30th, foreign stocks relative to the S&P 500. Monthly charts with the 50-month moving average. And a January 30th chart of XME relative to SPY also showed incremental improvement relative to what we had in the rearview mirror, again going back to calendar year 2015. And all of this is about having a game plan, while simultaneously monitoring the health of our positions and the general market. In recent years, head-to-head comparisons have been relatively simple. Tech, semis, and large cap growth dominated. As we've shown in recent weeks and recent months, that's not the case today. We have much broader participation. We shouldn't be asking, should we add defense stocks? Should we add to our position in foreign stocks? Or should we add to our position in metals? We can't make those decisions by looking at those charts in isolation. It's an opportunity cost. So if we put $1 here, we could have put it somewhere else. And thus, this week we performed a detailed opportunity cost analysis using hard data. Objective questions with objective answers. This is a zoomed out look at the spreadsheet, allowing you to see the level of detail. In this segment of the video, we'll walk through some of the concepts used in this analysis and cover the final results. If we're trying to decide where to allocate scarce resources, we want to take something like FNDF, foreign stocks, and compare it head-to-head to all of the attractive alternatives, and we want to do so on multiple time frames. This is one of the data sets used in the analysis, from the 20-day moving average in blue all the way out to the 250-day moving average. We looked at numerous charts examining the relative trends using the 30, 40, and 50-week moving averages. Went out a little bit longer on the spectrum to the 200-week moving average and the 30-month moving average shown on this chart of SCHG as in George. We also examined very long-term trends, relative trends using the 50-month moving average and monthly clouds. We also included a shorter-term look with the weekly clouds. And after hours and hours of analysis, we produced a relative stack rank. Thus, based on the hard, objective data, spanning multiple time frames using inputs from the 20-day moving average all the way out to the 50-month moving average, your strongest relative trends up here, your weaker relative trends down here. When the market was extremely volatile earlier in the week, our SVM scores basically said it still looks like a secular trend, but you can do the same thing visually with charts. This is the market on February 6th. It's a monthly chart. Snapshot was taken at 10 a.m. Eastern Time. It's probably fair to say the present day, early February 2026, still looks like a secular bull market. Nothing concerning up in this region here, and nothing concerning down here relative to the strength of the longer-term trend. If this starts to morph into something more like this or this, concerns would increase. Now, clients and regular viewers know the secular volatility model asks hundreds of questions, again on multiple time frames. Here's another example of one of the inputs used in that model. It's Bollinger Bands. We've purposely removed price, allowing us to focus on the Bollinger Bands. You can see in 2012 here, we get this tight look. And the resolution in 2013 and 2014 was bullish. We also had a tight look here in 2015, but the outcome was almost the polar opposite. Fairly significant drawdowns heading into early February of 2016. This is relevant because in the present day, we also have a tight look. But the good news is the slopes on the same Bollinger Bands, in terms of the setting and the time frame, they still look constructive on February 6, 2026. If this look here were to flatten out and morph into something more like this, then concerns would increase. But right now, it's probably fair to say the present day looks a lot more like late 2012 relative to late or the second half of 2015. And as always, that's based on the chart in front of us. Is it possible that this will evolve into something more like this? Absolutely, positively, yes. It may happen very, very soon. It just hasn't happened yet. Now, if we were to take the same Bollinger Bands with the same settings, but look at a relative chart, this is large cap 4 and FNDF relative to IWF, large cap growth in the United States, we can see observable improvement here, but there's nothing earth-shattering on this chart. This is observable improvement in here, and it eventually failed and went on to make a lower low. It is a good sign that what once acted as support did not act as resistance here as it did here. So this is an important area here. We're trying to break above the downward sloping trend line, and we're trying to break back above these areas here that could potentially have acted as resistance. So we'll learn something either way here. This look here would align with the measured approach. Yes, it's possible this is an early stage trend that's going to move in this direction, but it's also possible that it's going to fizzle out as it did in Q1 of 2023. Similar concepts here. It's a weekly chart of gold GLD relative to SPY. There's no question that this tight look with the moving averages here that range from the 125 week all the way out to the 425 week, the fact that those trends are converging here and the fact that we've come back and tested it and made a higher high, that's all very constructive. This looks a lot better than this region over here where the sellers came right back in and dominated. That's why we wanted to see When we were here, here, and here, was this going to be a repeat of this failure? And the answer thus far is no, it is not a repeat of the failure. And the fact that you're patient and you're waiting for this higher high is relevant. It doesn't mean this flip is going to work. It just tells us that the probability of getting a failed rally here is lower today than it was in this region here. And in this region here, it did fail. And all of this is taking place below these downward sloping long-term weekly moving averages. That's not the case today. All of this consolidation has taken place above the same moving averages, telling us to keep an open mind about gold relative to the S&P 500 eventually breaking above this long-term downward sloping trend line. Notice when you get above the moving average cluster in this region here, you rallied for years. This is that constructive converging look here telling us that we should be open to the ratio eventually getting out into this white space. Having said that, it is still well below a clearly defined and downward sloping trend line. The look of this chart and the look of this chart aligns with an incremental and measured approach. Similar situation here. This is XME relative to SPY, metals and mining stocks, the stocks of metals and mining companies. So this is equity relative to equity, XME relative to SPY. This is a shift in human behavior. This looks different relative to everything that we saw dating back to Q1 of 2015. And once again, a very constructive converging look, turning up look on the long-term weekly moving averages. The longer above, the more relevant it becomes. Similar situation here. FNDF, large cap foreign stocks relative to SPY. This region here, you can see we never exceed these long-term weekly moving averages here. That's different in the present day. It's also relevant that we made a higher high above this high from Q1 of 2025. Why? Because this rally here looks constructive, but it never follows through. It never exceeds this high and only exceeds this high momentarily. This looks convincing right now and somewhat powerful, and it tells you that this move off of this low could be the beginning of a long-term trend reversal. Having said that, there's still a lot of hurdles to clear up here. If we drew horizontal lines in this region here, that's potential resistance. So this trend has gone against FNDF for years. Hence, it's prudent as a trend follower to be highly skeptical of this turn. As the evidence improves, if it continues to improve, then we're happy to add to our position. There's no question that this looks better than all of this, and this looks different relative to all of this. The strength of the trend has never been in this region here, dating back again to 2015. This high here is higher than this high here, and it's considerably higher than the tariff scare high from Q1 of 2025. Incremental improvement, hurdles remain, measured pace. Keep in mind, all of these positions look favorable in isolation. Case in point, the lowest ranked ETF on this list for a long-term trend follower, XLF, looks fine in isolation. It's a 20-day moving average all the way out to the 250-day moving average. It's not a full-bore bullish look, but during Friday's session, XLF was above the 20-day moving average. And even though the large cap growth ETFs, VUG, SCHG as in George, IWY, and even SPYG rank in the lower half of the stack rank shown on your screen, SCHG as in George still well above an upward sloping 30-month moving average. VUG showing some recent weakness, but trading well above an upward sloping 200-week moving average, telling us, based on what we know today, even if there's going to be some give back, the base case would be that it's a 100% normal and to be expected correction within the context of an existing uptrend until proven otherwise. So the fact that VOO and SPY and ACWX foreign stocks, so there's the S&P 500, S&P 500, and broad diversified foreign, even though they're low or relatively weak in this analysis, in isolation, ACWX batting 5 for 5 on the weekly cloud. VOO, the S&P 500 ETF, very, very similar to SPY, batting 5 for 5 on the monthly cloud. In SPY in isolation, the S&P 500 during the session on February 6th, this is a constructive look. Typically, when you get this cluster look and you break out to a new high, you get a rally, correction, consolidation box in this window here, a break to a new high, a tight and constructive cluster look. This look here tells you to be open to potentially the stock market rallying for years with 100% normal and to be expected corrections along the way. Not a prediction in any shape, form, or fashion, but it's really not debatable. This is a constructive look here. This breakout to a new high is constructive, and the fact that these moving averages are separating, that's the early stages of a strong trend look. Early stages of a strong trend look. In this case, the market rallies for well over a year. Again, not a prediction in any shape, form, or fashion, but SPY in isolation, even after the volatility this week, looks fine. This is a full-bore bullish look. Blue, the fastest moving average on top. Price above all the moving averages, and the slopes of all the moving averages are up with the slowest moving average, the 50-week moving average, on the bottom. And that would align with the affirmative answer to this question. February 6th, it still looks like a secular bull market. Earlier this week, even at the lows, secular volatility scores, trend strength scores still look like a bull market. Thus, in this environment, the base case still intact. We're in a secular bull market primarily driven by favorable demographics with a boost coming from AI and a potential for improving productivity, which would in turn assist with the problem of inflation. Our goal remains to navigate between a point A and a point B that could be several years down the road. We don't want to let 100% normal and to be expected drawdowns, especially the fear of it, cause us to overtrade and let the left side of the ledger interfere with the primary goal. Having said all of that, at some point, we know with 100% certainty that a double-digit drawdown is coming again in the S&P 500. And we also know that at some point in the next 5 to 10 to 15 to 20 years, a catastrophic drawdown is coming in the S&P 500. And thus, the only way that we can continue to use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.